If I started investing from zero today, my 7-step strategy. Imagine waking up tomorrow with absolutely no investments, no portfolio, no assets, no stocks, just a completely clean financial slate. No accumulated wealth, no financial safety net from investments. Just your income, your knowledge, and the decisions you make from that moment forward. What would be the smartest way to begin building wealth from zero? This is not a theoretical question. Many people start their financial journey from exactly this point. And if I had to begin again today, with everything I've learned over the years, there are several things I would do very differently. Like many beginners, I made mistakes when I first started investing. I chased trends. I worried too much about short-term market movements. And sometimes I overcomplicated things that were actually simple. But investing does not have to be complicated. In fact, the most successful strategies are often the most straightforward ones. In this video, I will walk you through the exact 7-step framework I would follow if I had to start investing from scratch today. This approach focuses on stability, discipline, and long-term thinking. Not risky speculation, not complicated trading strategies, just practical principles that can help anyone start building wealth with confidence, as we are going to review this in 7 steps. Step 1. Build your financial foundation. Before buying a single investment, I would begin with something that many beginners overlook: financial stability. Many people rush into investing because they feel pressure to start immediately. They see stories of people making money in the stock market and feel that they are falling behind. But investing without a solid financial foundation can be dangerous. Unexpected expenses are part of life. A sudden car repair, a medical bill, a temporary loss of income. If you are forced to withdraw money from investments during a market downturn, you may end up selling at a loss. That loss might have recovered over time if you had been able to stay invested. This is why building a financial foundation is the first step. For me, that foundation would include 3 key elements. First, eliminating high-interest debt. Debt with high interest rates can grow faster than most investments. Paying it off first creates a much stronger financial position. Second, building an emergency fund. This fund should ideally cover several months of essential living expenses. It acts as a financial buffer that protects your investments from being touched during emergencies. And third, understanding your monthly financial situation. You need to know how much money you can safely invest without creating financial stress. Once these 3 elements are in place, investing becomes far more sustainable. You are no longer investing out of pressure. You are investing from a position of stability. Step 2. Define a clear investment purpose. One of the most common mistakes people make is investing without a clear purpose. They download an investment app, they buy a few trending stocks, and they simply hope everything works out. But investing becomes far more powerful when it is tied to a meaningful goal. If I were starting again today, I would begin by asking one important question. What is the real purpose behind this money? Perhaps the goal is financial independence. Perhaps it is buying a home. Perhaps it is creating long-term financial security for family. Or maybe it is simply building the freedom to make life decisions without financial pressure. When you define your purpose, investing becomes more than just numbers on a screen. It becomes part of a larger life strategy. Your goals determine how long you plan to invest. They influence how much risk you are willing to take. And they help you stay calm when markets fluctuate. Without a purpose, market volatility can feel frightening. With a purpose, it becomes part of a long-term journey. Step 3. Choose the right investment platform. At this stage, many beginners feel overwhelmed. There are countless investment platforms, brokers, and account types available. It is easy to spend hours researching without actually taking action. But the truth is much simpler than it appears. Once your finances are stable and your goals are clear, The next step is simply opening an investment account. That one small action transforms you from someone who is thinking about investing into someone who is actively participating in the market. Different countries offer different types of investment accounts. Some provide tax advantages. Others are designed specifically for retirement savings. Some platforms offer a wide range of global investments, while others focus on local markets. But the most important step is not finding the perfect platform. The most important step is simply getting started. Investing is something you learn through experience, and the sooner you begin, the sooner that learning process starts. Step 4. Start small but stay consistent. A common myth about investing is that you need a large amount of money to begin. In reality, consistency is far more important than the size of your first investment. Even modest monthly contributions can grow significantly over time. This happens because of one of the most powerful forces in finance: compounding. Compounding occurs when your investments generate returns, and those returns begin generating additional returns. Over time, this creates a snowball effect. The growth may seem slow in the beginning, but as time passes, the momentum becomes stronger. This is why starting early can be incredibly powerful. Small amounts invested consistently over many years can grow into substantial wealth. The key is not trying to invest perfectly. The key is simply continuing to invest consistently. Step 5. Diversify your investments. Another mistake beginners often make is concentrating their money in a single investment. One company, one industry, or one trending asset. This approach can sometimes produce exciting short-term results, but it also introduces significant risk. If that single investment performs poorly, the entire portfolio suffers. This is why diversification is so important. Diversification means spreading investments across multiple companies, industries, and regions. Instead of relying on one business or one sector, you build exposure to a broad range of opportunities. One of the simplest ways to achieve diversification is through index funds. Index funds track entire markets rather than individual companies. They allow investors to gain exposure to hundreds or even thousands of businesses at once. This approach reduces risk while still allowing long-term growth. It also removes the pressure of trying to predict which single company will perform best. Step 6. Automate the process. Over time, I learned something surprising about successful investing. It is often very boring. Many people believe investing requires constant monitoring. They check their portfolios every day. They react to every market movement. But this behavior often leads to emotional decisions. Markets naturally rise and fall. Trying to react to every movement usually creates more stress than success. A better approach is automation. Setting up automatic monthly investments removes the need to constantly decide when to invest. The money is transferred automatically. Your investments grow steadily in the background. Automation turns investing into a habit, and strong financial habits often produce better results than complex strategies. Step 7. Stay calm. During market drops, markets have always experienced downturns. Economic recessions, financial crises, unexpected global events. These moments can feel extremely unsettling. Watching investment balances decline can trigger fear and uncertainty. But history tells an important story. Every major market downturn has eventually been followed by recovery and growth. Investors who remain patient during difficult periods are often rewarded over time. The market does not move in a straight line. There will always be periods of volatility. But those periods are part of the long-term journey. Successful investors are not those who perfectly predict market movements. They are those who remain calm and stay invested. Closing reflection. The long-term mindset. If I had to begin investing again today with absolutely nothing, this is the strategy I would follow. First, build a strong financial base. Second, define a clear purpose. Third, open an investment account. Fourth, start small but remain consistent. Fifth, diversify investments. Sixth, automate the process. And finally, remain calm when markets fluctuate. Investing is not about perfect timing. It is about patience, discipline, and time. Those who understand this principle give themselves the greatest advantage, because wealth is rarely built overnight. It is built gradually, through consistent decisions made over many years. Now, if you found this video helpful, it would mean a lot if you supported the channel. Please consider liking this video so more people can discover it. Subscribe to Lux Latitude Investment Stories for more insights on investing, global wealth building, and financial strategies from around the world. And if you know someone who is thinking about starting their investment journey, feel free to share this video with them. Because sometimes the most important step toward building wealth is simply learning where to begin. Thank you for watching, and I will see you in the next investment story.